Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week we bring you three things in credit markets that caught our eye that we believe you should know about. And we're doing this from our global headquarters in the heart of Midtown Manhattan for the first time in 14 months. And that's a good thing. All right, let's get started. This week our three things are: 1, the press is reporting the Fed will begin to unwind its corporate bond investments made to stabilize credit markets in the early days of the pandemic. Is this a taper tantrum, corporate style? 2, credit markets are normalizing. What does that mean for supply and spreads? And 3, KBRA has published its financial strength rating report on Lloyd's of London. It's worth a look. All right, let's dig a bit deeper. The press is reporting that the Federal Reserve will begin unwinding its corporate bond holdings accumulated in the secondary market corporate credit facility, the clumsily named SMCCF, the emergency program announced in March 2020 that was so instrumental in calming markets in the early stage of the pandemic. At April 30, the facility held $5.2 billion in corporate bonds and another $8.6 billion of corporate bond ETFs. At first blush, this feels like an important support element is being pulled away from markets trading at or near historic tights, risking a sort of taper tantrum, corporate style. Here's why you don't have to worry. 1, credit markets are solid. Massive stimulus and the successful vaccine rollout have put us in the midst of 2021 real GDP growth in the U.S. expected to come in at 3 to 4 times the long-term average. That's boosting corporate earnings and reducing default expectations to levels consistent with a healthy economy. 2, the actual buying was not all that big. $5 billion of corporate bonds is equal to less than 1% of what has been issued thus far in 2021. 3, the Fed can take its time. The intent is to have the redistribution completed by year-end. The Fed can be patient in its unwind. And 4, investors know it can be implemented again. Now, you've now trained the market to expect federal intervention in a downturn. Clearly, the onset of the pandemic required extraordinary intervention, and the unqualified success of the program suggests corporate bond purchases are now part of the Fed's toolkit. And this last point is the controversial part. Where do policymakers draw the line? How severe does the economic threat have to be to trigger support? Doesn't this encourage excessive risk-taking in the name of moral hazard? And doesn't this create and perpetuate zombie companies and the economic drag that goes with it? In any event, we believe reversing extraordinary support when appropriate, as former Treasury Secretary Mnuchin did last year-end with 5 of the CARES Act facilities, is good discipline, even though we, along with the Fed, question the timing of those expirations. The timing of this move, with the recovery strong and the pandemic in retreat, is much better. All right, on to our second thing. The corporate bond markets return to normal. Sometimes you have to take a step back to appreciate just how much the corporate bond market has grown and how much new supply has been taken down throughout the pandemic period. Combined IG and high-yield outstandings are up 10% from year-end 2019 and are now close to $9 trillion. Issuance last year, of course, was literally off the charts with more than $2.3 trillion between the two sectors. All of that digested, by the way, in the context of spreads which are at or near historic tights. And that speaks to how the credit market has expanded. IG is now a big liquid market, especially with the Fed establishing itself as an explicit or implicit backstop. And leveraged finance is not your father's or mother's relatively small market that used to run hot or cold. It's now a $3 trillion market that held up well under the stress of the pandemic. So where are we now? The return to normal doesn't apply just to the economy, it also applies to the bond markets, with rates rebounding off of the ultra-low bottom and corporate bond issuance moving back to trend line. That means a significant fall-off in IG issuance, which is down 33% year-to-date from the emergency-fueled supply deluge in 2020, and a significant pickup, up 56%, in high yield, which has benefited in 2021 from the highly constructive fundamental backdrop and the favorable comparison to the prior year, where high yield did not initially benefit from the Fed's backstop. The implication for spreads is we would expect the positive technical in IG to keep spreads at or near post-GFC tights. And we would say the same for high yield despite the surge in new issue, which we do expect to last throughout the year, in part because the asset class becoming less sensitive to rising rates, or at least the prospect of rising rates. All right, on to our third thing. KBRA assigns an insurance financial strength rating to Lloyd's of London of AA-. We bring this to your attention this week because of the unique and complex credit story that is Lloyd's that has been captured in our recent rating report detailing our rationale. You can find the report on our website, KBRA.com. It's free. All you have to do is register. And I wholeheartedly encourage you to have a look. An important credit consideration is Lloyd's multifaceted capital structure. Here's Peter Giacone, Managing Director and Head of KBRA's insurance practice.
The Lloyd's market provides multiple successive layers of capital to respond to policyholder claims. Virtually all of the available capital is equity, which KBRA views as a credit strength. The first line of defense are assets at the syndicate level, which consist of premiums collected and held in trust. After that are funds at Lloyd's, or FAL, which represents capital to support members' underwriting, not unlike what exists at a typical insurance operation. The level of FAL is determined by each individual member in an amount that it deems sufficient to cover a 1 in 200-year loss to ultimate. Lloyd's then increases the requirement, effectively building in an additional buffer for extreme losses, which results in an economic capital assessment for every member. Then things really get interesting. If the first two layers are insufficient to cover valid claims for a particular member, there is the central fund at Lloyd's, which, if approved by the Corporation of Lloyd's, is available to satisfy claims. The central fund is also supplemented by the proceeds of subordinated debt, which, notably, are structured such that claims are paid ahead of payments owed to bondholders. Finally, there is the ability of Lloyd's to call on its members to fund additional capital. So what you have at Lloyd's is a combination of equity capital, which, by virtue of its multiple layers, provides several and mutual coverage of policy claims. It is a very robust capital structure that does not exist at this scale anywhere else in the insurance sector, and, in KBRA's view, is effectively the foundation for Lloyd's strong financial strength.
Thank you, Peter. We'll leave you with a comment from Lloyd's CFO, Burkhard Kies, who explained in its press release announcing the rating, quote, "We believe it is important to have a diversity of views in the ratings market and welcome KBRA as a new entrant that will provide a fresh perspective on Lloyd's," unquote. Again, you can find the report on KBRA.com. So there you have it. 3 things in credit. 1. The Fed's unwind of its corporate credit investments built up in its highly successful effort to stabilize risk markets will not disrupt markets in our opinion, but its signal that it stands by ready to act as necessary has left a lasting impression on risk markets. 2. Credit markets are normalizing, and that means reduced supply in investment grade compared to a year ago and more supply in high yield. And yet in both cases, we expect spreads to hold in. 3. Take a look at KBRA's financial strength rating report on Lloyd's of London. It is a fascinating read. As always, thanks for joining us. Don't forget to check in on KBRA.com for our latest rating reports and research. See you next week.